matching the demand of people that want a taxi or go somewhere with a driver who's willing to take someone somewhere.
Look at for stability, but the point I'm at right now is you won't be able to afford that stock, and that's okay. If you don't have the money, I don't have a solution for you. You just don't have the money, so look for stocks that are a little bit cheaper. I look for stocks that are cheaper all the time, and I'll show you some more cheaper stocks in this video as well when I do some my live trading. Now, let's focus on some quality names. Some quality names for me, by the way, I'll just tell you them right now. SoFi, American Airlines. I like HIMS because of the strong marketing practices that they have. You know, if you don't have that much capital, Snapchat's pretty good. It's under $10 per share. And there's several other names. Archer's also like under $8 per share or so. There's several names that you can definitely trade. But of course, having more capital, of course, helps you because it helps you diversify. Now, when you have a portfolio that's about $50,000 plus, the entire market just opens up. Everyone wants you at that point, right? You got Google, you got Tesla, you got Microsoft as well. So these are some of the best companies in the world where the premiums might be a little bit lower in terms of percentage-wise, but the quality is unmatched. So if someone puts there, it's like, you can't even argue with me. Like, how could you go wrong selling a put option on Microsoft? Like, what do you have to say about that? Of course, it's safe, right? Now, on the fundamental analysis for put sellers is pretty different from stock pickers. I'm not looking for the next Amazon, guys. You know, a lot of people confuse me. I'm an option trading coach. I love helping people get results. I'm not spending all my time looking for the next Amazon. You know, I'm probably, to be honest, I'm just not cocky enough. I don't think I'm going to find the next Amazon. I'm not going to. The thing is, I don't need to. The most boring businesses can make a lot of money, right? So the boring stuff, the more stable stuff is what I'm after. I'm looking for consistency as well as growth, okay? And it's a lot of big companies have a lot of growth. So I'm looking for companies that won't go bankrupt, that will probably be higher in a year, right? And it's not that difficult to know what's going to be higher in a year. Okay? As long as the economy doesn't tank, right, which I can't control. It's out of my control what the stock market does, but it is in my control to pick a business that has a good value, right? That's going for good valuations. So my checklist again, positive free cash flow, high free cash flow as a percentage yield. Okay, that's something that I go a little bit deeper in my program. Debt to equity ratio under 2. Revenue growth, even if it's slow, some revenue growth. Recently, Chipotle, they reported weak same-store sales. That's an issue. Weak same-store sales is an issue because that's saying that less customers are going to do business at that location. AK for Chipotle means less people are eating their burritos at that same location. They're opening up more stores, but some of those same stores are suffering a little bit with customer, not coming as much. So that's all the things that I'm really looking for. Same store sales growth, and if the business model is just conducive for scaling. Not all businesses can scale infinitely to the moon, right? Some can, some cannot. Some require heavy infrastructure. Some are software businesses, so they have unlimited scale, right? Let's talk about dividend stocks and mention them real quickly. Dividend stocks can be great for put selling. The dividend provides extra cushion if you do get a sign, right? So if you get a sign, I have a dividend paying stock. But if you don't get a sign, right, if you sell a put option, the dividend actually does hurt you because when a stock pays out a dividend, the stock's price typically drops by the dividend amount, right? So you have to be aware that a sell put might have a high premium, but it might also have a high premium because people that are buying that put option, they know that when the stock has a high dividend, say AT&T, which yields I think like 6% annually, when they pay out a dividend, the stock drops by 1.5%. So if you're like, hey, this option looks really, really good, it might be because there's a big dividend payment, but typically that's not something to really be concerned about. Dividend-paying stocks are also going to have a lot lower volatility, so they're usually not the most profitable. So I mentioned ETF like SPY in this video. I just want to point out that ETFs like SPY, QQQ, IWM, these ETFs are very strong. They're very good. So if you're someone that's just looking to retire and make safe income and you don't want to have single stocks and you're a beginner, it's okay to just sell put options on ETFs such as SPY. Another ETF that I personally like is FadeItLuie, which is the Bitcoin ETF. It's good to have some of that in your portfolio as well. All right, now let's talk about why not all companies can scale infinitely to the moon, and some businesses are just built better for scaling. So I'm going to show you something really valuable in the statistics tab. I'm going to show you the profitability of Microsoft, and I'm going to compare it to a company that can't scale as well, which is Starbucks. Okay, so two big companies. Microsoft here has a PE ratio of 30. The core PE ratio is, what will the PE ratio be in 1 year if analyst estimates come true? So again, we'll put it up on the screen. Okay, the stock price is $100, right? And then the PE ratio is 10. That just means that it's earning $10, $100 price divided by $10 worth of earning gets you a PE ratio of 10. Okay, so that's what it means. So if next year the company starts to earn $20 in earnings per share and it's still worth $100, then it's going to be $100 divided by $20 in the new PE ratio will be 5. And that's why people who look at PE ratios, they say, for example, Palantir had a 600 PE ratio and that's bad and this company is overvalued. They completely do not know what they're talking about. This is a noob investor that only knows one metric. It's completely wrong. Looking at only PE ratio is like looking at your wife, and just because she has small hands, you say that's a bad person. Makes zero sense, right? You cannot judge a person's character based on their hand size. PE ratio is like that. PE ratio is good to look at, but if you only look at PE ratio just by itself, it's pretty useless because companies can have extremely high PE ratios and they can go down by half, by 4 times, by 10 times. Tesla had 1,000 P ratio, and the next year was 300. The next year was a lot less, right? So a P ratio can change drastically. And I just wanted to point that out because a lot of people mistaken a high P ratio for a bad stock. That could be furthest from the truth. In fact, oftentimes a company that is wildly growing in terms of revenue and has just become profitable will have the highest PE ratio. And that could be a really good thing for scaling a business. So Microsoft can scale the business easy because let me just show you their profit margin. So their gross profit is $202 billion. They're growing pretty quickly. They have a lot of cash. They actually do have some debt, but that's okay. Obviously, Microsoft can pay off their debt. That's not really an issue. But you want to look at profit margin, which is right here, 35%. So every time that Microsoft basically makes money, they're bringing 35% down as profit, okay? So that's really big profit. And that's the difference between a software company that can scale a lot easier because most of Microsoft products are software, like Windows, Office, Azure. So once the software is built, selling it to 1 million more users literally costs almost no money at all. And the margins are actually only expanding because the more sales there are, the more these sales will cover fixed costs. So your actual margin actually increases and scales even better with more sales, right? Now, that's not the case for something else like a Starbucks because Starbucks has much higher variable costs. That business cannot scale as efficiently because every new store or additional customer requires baristas, rent, ingredients, utilities, equipment, so the cost is not really directly going to be as scalable. And I'll show you that right now. So we're going to type in Starbucks here. Because they have a lot more employees, they actually make a lot less money per employee. There's some businesses out there that have millions of dollars per employee. Google is one case. And then some other businesses like private content, websites, subscriptions to beautiful women that obviously are overpaid. Those type of companies, I'm not going to mention, can make $5 or $10 million per employee or $50 million per employee. Fortunately or unfortunately, I'm not into that, but it's one of the most scalable businesses when you look at more content. And that's why businesses such as Netflix, such as Google are so powerful. And then other businesses such as a Starbucks is going to have a much harder time to really scale their business. So if I go to statistics right now, we will take a look that the 4P ratio is actually very similar to Microsoft, but if we go to profit margin, it's literally, instead of 35, it's literally 5%. So super small margin that pretty much is very difficult to scale. Alrighty, let's now talk about timing the market. I don't try to time the market, but I do understand market cycles, and I also understand technical analysis. Technical analysis is a very important tool that can help aid in stock selection. It can help you understand what strike price to sell a put option at. So let's go over several examples right now on technical analysis. This is probably one of the most important parts, especially if you're a beginner. I want to show you a current example of a a stock that I want to analyze for you right now. And I'm also going to show you a little bit older of an example where I was 100% right, why I was right, the trade that I made, and how I profited from that trade. So let's go over two of these examples. So let's do the technical analysis portion of this course right now. We're going to be using two different stocks, and I want to show you the key indicators that I use, and I want to keep it super simple and very beginner friendly for you to understand and analyze a stock properly using technical analysis. So check it out. SoFi right now trading for $12.70, and I want to go over the chart and just kind of tell you what has happened with the chart, and then how I would analyze this if I wanted to make a decision whether to buy or sell or trade a specific option. So look, SoFi has traded as high as $18 per share. You can kind of see here very logically on the chart, back in January 2025, it reached a high, and that was the highest point in the past 6 months. So I'm looking at a 6-month period, and this is the best time frame to really use. If you go out really far in terms of date, then, that's like really, really old data. If you use too short term, well, that can also, kind of skew the picture as well. And too short-term data is also not as useful. So 6 months is the perfect amount of time to really analyze the charts. And by the way, when I was working at a hedge fund, the quant analyst who was incredibly smart, he was a genius, also said that 6-month time frame was what he used. So yeah, sticking to 6 months, you can see here that SoFi reached the high of $18 per share. And then it has been basically on a bear trend along with the entire market in 2025, unfortunately. Been a lot of volatility. So you can kind of see here what's going on. It reached the high 18, and then it reached another kind of peak here at about $17 per share. This is really interesting because you can essentially draw a trend line here. So if I were to draw, there's a new version, by the way, of Yahoo Finance. But if you draw from here to here, you can see that it's been very interesting and has actually predicted kind of the downward pressure in the stock. You can see high 18, high 17, and then essentially we just hit another peak at $13 per share. Now, here's the interesting thing. Although this is a bear trend and has been a bear trend, at some point you want to see where the stock can find support. You can actually see a pretty nice support here, a double bottom pattern. So a double bottom pattern is basically within a fairly short amount of time, a stock hits a bottom, tries to recover, hits a bottom again, and then investors say, hey, we really think that this is a bottom based on investor behavior and psychology. They think the stock is low here, and there was heavy selling pressure. You can even see here by the volume, there was just very heavy red days. You can see multiple big red days of selling pressure. So the stock has basically have pretty good support here, and now we're back on the uptrend. So that's kind of visually what you should be looking for. Aside from the visuals, you can now see that I'm using 3 different indicators. The first one is the Bollinger Band, hands down, the most important indicator that you can ever use in trading, period. Okay, the Bollinger Band essentially looks at what is normal and what is not normal. Okay, what range do we see the stock going? Okay, and the Bollinger Band is based off of statistics and math, some basic statistics and math. I won't go too deep into this course. It'll be a very long explanation. Let me give you this short and simple explanation. This Bollinger Band is using something called the bell curve. The bell curve kind of looks like this. Okay, you'll see it on the screen right now. Okay, and you can see that in the middle of the bell curve, about 68% of the data is within one standard deviation. Okay, what does that mean? Well, if you look here at the Bollinger Band, pretty simply said, it gives you some options.
What's going on, guys? FadeItLuie here, bringing you guys a brand new video. We're going to be doing a high fade on my boy, so stay tuned. What's going on, guys? FadeItLuie here, bringing you guys a brand new video. We're going to be doing a high taper on my boy, so stay tuned. We're going to be starting off by saturating the hair. We're starting off by saturating the hair and combing everything in place, making sure everything's nice and smooth. Now that we're done laying down the hair, we can move on to the back taper and use our gold FX to create our first guideline. Be sure not to press too hard here because you don't want to make the guideline too harsh. Now that we're done buttoning them out, we can move on to our no guard all the way open and create our second guideline. We're also going to use the lever midway and all the way close to help us erase that initial guideline we created with our trimmers. Now that we're done blending our initial guideline, we can move on to our one guard all the way open and create our third guideline. We're also going to use the comb to feed the hair into the clipper and flick out as much as possible. We're also going to use the lever midway and all the way close to help us soften up this line and get ready for the half guard. Moving on to the half guard, this is going to help us connect the one guard all the way open to the no guard all the way open. Since we're done with the lower guards, we can move on to our two guard all the way open and feed the hair into the clipper using the comb. We're also going to use the lever midway and all the way close to help soften up this line and get ready for the 1.5 guard. Now that we're done softening up the line with the 2 guard and its lever, we can move on to the 1.5 guard and erase it completely. This 1.5 guard is going to help us connect the 2 guard all the way open to the 1 guard all the way open. Sometimes there's still a faint line after using your 1.5 guard, so switching over to your 1 guard all the way open and using its corners would definitely help. Now that we're done detailing, we can move on to our 3 guard all the way open, and again, we're going to use the method to feed the hair into the clipper using the comb. We're also going to use our 4 guard all the way open. This is going to help us blend into the bulk on top. Now that we're done with the back taper, we can move on to the sides. And we're going to start off with our Gold FX. Now that we're done with the back taper, we can move on to the sides. And we're going to start off by using our NST outliners to ball them out. We're then going to use our foil shavers to remove the stubble and make it nice and clean. Now that we're done removing the stubble, we can move on to our no guard all the way open and create our second guideline. Again, we're going to use the lever midway and all the way close to help us erase that initial guideline we created with our trimmers. Be sure to use your opposite hand to stretch your skin to give you more room to blend. Now that our initial guideline is blended out, we can move on to our 1 guard all the way open and create our second guideline. Now that our initial guideline is completely erased, we can move on to our 1 guard all the way open and create our third guideline. As you guys can see here, I'm using the corners of the blade because the taper area is a little smaller than the back. Now that we're done softening up the line with the 1 guard and its lever, we can move on to the half guard and erase it completely. This is going to help us connect the no guard all the way open to the 1 guard all the way open. Now that we're done with our lower guards, we can move on to the 2 guard all the way open, and we're also going to use the corners of the blade to flick out as much as possible. Now that we're done creating and softening up the line with the 2 guard and its lever, we can move on to the 1.5 guard and erase it completely. This is going to help us connect the no guard all the way open to the 1 guard all the way open. Now that we're done creating and softening up the line with the 2 guard and its lever, we can move on to the 1.5 guard. This is going to help us connect the 1 guard all the way open to the 2 guard all the way open. Moving on to our clipper over comb method, we're going to use our horizontal and vertical blends to debulk and blend the hair as much as possible. It's always best to make sure that the hair is saturated so it's easier to pick up with the comb. Now that we're done with the side taper, we can move on to the back of the ear edge up, and we're going to start off with our T outliners at the bottom and work our way to the top arch using the corners of the blade. Always be sure to use your opposite hand to debulk. Always be sure to use your opposite hand. Always be sure to use your opposite hand to move the ear out of the way to give you more room. Moving on to the front line, we're going to use our comb and we're going to separate the edge up from the rest of the hair on top. Since this hair is short on top, to hold it in place, we're going to use a little bit of gel to separate the edge up from the top of the hair. Now we're going to debulk the edge up with the no guard all the way open. You want to use your opposite hand to hold the top hair so you don't cut it accidentally. Using our T outliners, we're going to start off at the middle and work our way to the sides. We're also going to make it as natural as possible without pushing the hairline back. You also want to make sure you keep the corners as natural as possible because you could make the haircut look a little bit awkward. When lining up the mustache, you want to be as gentle as possible because you could bite the top of the lip with the trimmers. Using our Gold FX, we're going to debulk his goatee and make sure all the stubble is removed. Before I remove the stubble with our foil shaver, I'm going to put a little bit of talc powder on his face so that the shaver could glide better. Now that we're done lining him up and removing the stubble from his face, we can move on to our Turkish razor and Derby Premium blades and make them as crispy as possible. When you're using the razor, you always want to make sure you stretch the skin as much as possible with your opposite hand and keep it at a 45-degree angle. This is going to lower the likelihood of you cutting someone. I hope you guys are enjoying the video. Please leave a like, comment, and subscribe. It's greatly appreciated. Also, make sure to check out my live streams.
20 trading days, which is like roughly 1 month. And the two standard deviations, this is what I'm explaining to you. Two standard deviations, a 2-move standard deviation would be about 95% of the data on the bell curve, okay? And let me explain it to you a little bit more simply. As you can see the bell curve on the screen right now, the 0 standard deviation, or like the very, very center standard deviation, would basically be, let's say that you were a man, you are 5'10", and you have a son. Your son on a 0 standard deviation is going to also be about 5'10", based on genetics. You'd be about 5'10". Now, let's say 1 standard deviation would be 6'1", and 2 standard deviations would be 6'4", right? So you can basically see how the Bollinger Band works for the stock right here. You can see that SoFi is trading within the Bollinger Band a majority of the time, and this is a 2 standard deviation Bollinger Band. And again, going back to the example, 2 standard deviations to the right would basically be, if you're 5'10", your son is 6'4". 2 standard deviations to the left, okay, 1 standard deviation lower would be 3 inches lower than your height, so it would be 5'7", or 3 more inches lower would be 2 standard deviations, which would be 5'4". So you can see how, stock trading, it has a lot of applications very similar to life. For, in this example, human height. So at the top of the Bollinger Band, it would be, unusual on the top end. The bottom of the Bollinger Band, it would be unusual on the bottom end. Okay, so the 2 standard deviations here basically tells you that the stock should be trading within this level. If it's trading outside of this level, it would be as unusual as the height example I made. Also, you can do an income example. So the average income in the United States is $16,000, let's just say, right? And 1 standard deviation would be making $100,000. 2 standard deviations would be making $140,000. And then, you can also go on for more standard deviations. However, it doesn't really make sense. Let me show you an example why it doesn't really make sense. You can actually change the Bollinger Band to 3. What this would do is it would make your trading even safer. And you'll see why. So if I go to 3 right now, and I click done, you can now see that this Bollinger Band has expanded. So it is telling you more unusual data. So, for SoFi to go up to $15 here in the next month, this would be very unusual based on the Bollinger Band. Or for it to fall down to like $8 per share, that would also be very, very unusual behavior. However, at 3 standard deviations, it's not that good because you're getting so unusual and you're getting so low risk that you're giving up a lot of the return. So I'm going to change this back to 2. And what this means essentially, for you to review this course, if you sell put options, you should be selling closer to 9. However, this is just based off the Bollinger Band. Let's talk about the other indicators and how to use them. Because the center of the Bollinger Band, for example, is 1140. And since SoFi is above, I would kind of go closer to that 1140. Now, this red line is the moving average. It's just saying, hey, if you take all the data for the past 50 days, I'm using a 50-day moving average. Some analysts, some traders, some investors like 60, some like 90, some like 30. I like just using 50. 50 is a good mix of really short-term and somewhat short-term and maybe some longer-term data. So using 50, I can pretty much make a better decision on SoFi that the 50-day moving average is hovering right around $12.20. So if I wanted to make a smart decision, and let's say that I wanted to sell a put option, I would sell it at about $12. Now there's multiple data points to support this. Middle of the Bollinger Band, 1140. Moving average, 1220. So, I'm getting an idea in a sense for, a good strike price to sell a put option. So here it would be $12. Now, the other indicator that I use is RSI. The RSI is basically very interesting for telling you the strength of momentum. So how strong is momentum of investor sentiment? So right here, you'll see that it's 55. 20 would be oversold, and 80 would be overbought. 55 is right around the center. And my overall analysis of SoFi at this point in time, we have many examples throughout time as I'm making this long course. It's taken me months to make this course. The technical analysis here tells me that SoFi is somewhere in the middle of its Bollinger Band. It's not overbought or oversold, and based on the moving average, it's right around this moving average. Therefore, what I would be doing right now is I would pretty much put a short-term neutral price target on SoFi in the short term, and even it's a little bit more on the expensive side since it is, towards the top of its Bollinger Band. For this reason, the best strategy that I would use right now, and I have my Discord calls on Mondays and Wednesdays, and I do my coaching, and SoFi is something that I trade all the time. A very simple decision for me to make on SoFi, and what I will do when the market opens up today is I will just be selling a put option for the $12 strike and collecting income on SoFi and looking to generate cash flow and acquire shares of SoFi for lower than the current price. current price is $12.70. If I sell a put option at 12, I'm getting a 70-cent discount, and I'm going to get paid for basically nothing. I'm getting paid to buy a stock that I want to own. So that's why selling puts is a great strategy, and this is why the Bollinger Band and the RSI and the moving average are the only really three indicators that I will use. And just for some comparison, just so you understand, there is so many different indicators, and a majority of them are just complete BS. After working in the industry, I've seen some of the best people just using the simplest indicators, just really using simple strategies, simple indicators, and I believe that to be the best to scale, to retire, to generate the income that you're looking for in retirement, and just to have enough money to really live your life without having to work. And in retirement, if you want consistent cash flow, safe cash flow, reliable income stream, you really want to go for simplicity rather than too much complicated techniques, complicated indicators. I don't believe in any of that. I've done very well just sticking to the basics. And just so you can see the indicators, a lot of this stuff, I don't even know what it is. Like the awesome oscillator, the center of gravity, the Chalkin, money flow, the choppiness index, the Darvest box. I mean, a lot of this stuff, like you can see I'm scrolling here, the Keltner channel, a MACD can be useful, though I don't use it all the time. I mean, there's so many indicators, and the majority of them you do not need whatsoever. So I'm going to save you a lot of time, a lot of hassle, and just tell you, keep it simple, and that is the best way to be profitable.
All right, guys, March of 2026, and I hope that you enjoyed the clip that was some time ago on SoFi when it was at $12 per share. And right now, SoFi is trading for just under $18 per share. And I want to analyze the technical analysis. So as you can see, the most important technical analysis indicator that I personally have been using for a very long time is the Bollinger Band. SoFi went on a pretty massive rise since 2025, and in 2026 it has been pretty rough waters. There's been some tariff concerns, an Iran situation, and more political stuff that has really impacted the market. Also, cryptocurrencies have been doing pretty bad, and because of cryptocurrency, multiple stocks that are in the fintech sector are down, such as SoFi and Robinhood. However, the long-term trend for SoFi has still been positive, and when I covered the stock, it was at 12, and now the stock is in the mid-17 range. But what you can see right here is a very important, pay attention to this, because this is really life-changing and game-changing stuff when you really understand the technicals, because most investors are misunderstanding this. They're making huge mistakes. And if you just understand the simple technical pattern, there's so much opportunity for you as an investor. Look, the stock went down, but it mainly did stay within the Bollinger Band. Yes, there was an overreaction in basically February 2026, and the stock ended up crashing down along with crypto. The crypto market crashed down, Robinhood stock crashed down, and many other even Mag 7 stocks ended up taking this nosedive. This was pretty unpredictable. But from here, it was predictable. It was very easily within the Bollinger Band, even above the Bollinger Band. The negative momentum was pretty obvious because the RSI also ended up reducing, but not below 20. That's very important. If RSI is below 20, that basically means the stock is oversold. But oftentimes there could be a sell-off, and if it doesn't go below 20, that could be an indicator or a sign. That's one of the pieces of my check notes that the stock can further fall lower. And here, SoFi ended up bottoming out around
if you would like to comment, subscribe, and appreciate also now. Make sure to check out my live streams. So if you would like to comment, subscribe, and appreciate it also. Make sure to check out my live streams. Create our third guideline. We're also going to use the comb to feed the hair into the clipper and flick out as much as possible. It's always best to make sure that the hair is saturated so it's easier to pick up with the comb.
Big opportunity because there's a double bottom pattern here, and now SoFi is trying to go lower, but it's really not managing to do that after multiple weeks, about 2-3 week period right now, where the stock is flailing and not doing much, and that's okay. That just means that a lot of investors have sold off. You can see the crazy red volume here was very hot, and then just many red days. Then again, pretty big red volume. And this to me tells that investors who are afraid of the stock, have lost confidence in the stock, are getting out. But the fact of the matter is, the insiders, so there's 3 insiders, Anthony Noto, Eric Schopenhauer, and one gentleman, forgetting his name at the moment. 2 gentlemen bought 5,000 worth of shares, and then Anthony Noto bought $1 million worth of shares. So insiders are buying, yet the stock is going down. They had the best quarter ever, over $1 million in a quarter. So the business is doing phenomenal, get the stock to move in the opposite direction. So on a technical chart, it's really important to understand how low are we, okay? Is there double bottoms, which yes, there is. How is the volume looking like? And very simply, even after this massive pullback, what is the moving average? The moving average is sitting at $22. What is the bottom of the Bollinger Band? We're there. We're at the bottom. If I zoom in here, you really can't currently get that much lower. The chances of getting lower are very slim to none. Of course, anything is possible. Trading is risky and options are risky, so you never really know, but probability-wise, the chances are fairly low. So when you see a stock coming down to its Bollinger Band, and the more I scroll in here, you can see we are at the bottom. That is a sign that there is going to likely be a bounce back to normal, and it's called mean reversion. A stock will typically come back to its mean, and that is true of biological organisms, of financial products, and many other things in life. Things bounce back to what's normal and what is average. So there is a pretty good likelihood that SoFi will bounce back. Now, we are trading in a very tight range right now, so this is just further good stuff, because for me, when there's a tight range, that tells me the stock is actually predictable. That tells me there's not a lot of uncertainty. As you can see here, there was a lot of uncertainty, and that's why the Bollinger Band ended up expanding and ended up being very big, and the stock ended up pulling back, and this only further expanded the Bollinger Band. And now, a lot of everything that could have happened has happened. There's like a whole war in the Middle East and stuff like that. So when you look at the stock pulling back in the current situation, this is what I would see as an opportunity to dollar cost average and purchase the stock near its bottom of the Bollinger Band. A lot of people that don't understand the Bollinger Band would be upset with the stock right now. I see this as a huge opportunity. I'm very excited about it. So understanding technical analysis can really give you a leg up versus other investors, specifically on the mental side.
So let's now talk about why people lose money selling put options. Plenty of people still find ways to lose money with this strategy. Let me break it down for you so you do not get caught up in these biggest mistakes that the most common people do make. Mistake number one, which is selling puts on garbage stocks for premium. You're just chasing the hottest stocks. Maybe that's a speculative biotech play. Maybe it's something like an IONQ or Rigetti or whatever those stocks in the quantum computing sector are. They're super volatile. Chasing those stocks, not really a good idea. There's a reason that those stocks oftentimes can drop by crazy amounts, right? Quality companies pay less premium, but they don't go down to zero. So would you rather make 2% a month on Microsoft, or maybe 10% a month on Rigetti, but then the next month it goes down, or whatever, not high quality companies. So that's the first one. Mistake number two is sizing your positions way too large, just way too big. This is the account killer. Someone with $50,000 in their portfolio sells a single $450 put option on Tesla. That's basically the majority of your portfolio. Tesla drops 30%, which it has done multiple times, and you're assigned. Now you have 90% of your account in one underwater position that you can't really diversify. So that's mistake number two. Mistake number three is fighting the trend. So a stock is in a clear downtrend. Again, trying to catch a falling knife can be very dangerous. Lower highs, lower lows, it breaks support levels. So the premium here is very juicy, of course, but the risk is just way too high. So, again, chasing stocks that are just in a really downward trend, not a good idea. Mistake number four is just not paying attention to earnings and events. The premium that you collect could be really high going into an event, but that event could cause the stock to basically crash, right? Or going into earnings, it's really good actually to sell put options in many ways, because
what the fuck did I do?
The volatility is going to be really high. That's cool. But then after earnings, there's an earnings crush. So it's good actually
fucking
in many
dumb.
cases to get in before earnings. After earnings, there's just no volatility there. So it's going to have very low premium. You're not going to really make much money at all. So really paying attention to earnings events. Mistake number five is not really having an exit plan. So if you're selling any put option, know what you're going to do if the position goes against you. Know that, do you like this stock enough to hold it up until the very end? If you do get assigned, that should be most of the time. But in some cases, if the stock breaks support levels, what's your exit plan, right? Will you take assignment, or will you plan on rolling it lower, right? Or will you just close it for a loss? Without a plan, you make emotional decisions in the heat of the moment. It's usually really bad ones. So mistake number six, over leveraging with margin. Now, this is something that I didn't really teach you in this course, and I'm not planning to, but some people are, they're going to use margin themselves. They're not going to get coaching from me. They're just going to do it themselves. In this case, you can very much make many errors with margin, because a lot of brokers will actually let you take a good amount of margin. People think it's free money. It gets really easy to create income during good times, but in bad times, they end up getting a margin call, and then they end up losing a ton of money. So using margin can be very safe most of the time, but then 1% of the time, market crashes, you end up in a super bad position, right? So just not managing your margin maintenance is mistake number 6. Mistake number 7 is chasing losses with more aggressive puts. This is like the casino typical psychology, right? You go bet on blackjack, you come in with $1,000, you're up, you made a lot of money, right? You don't get off the table, you end up losing a lot of it, and you go, all of a sudden you catch yourself at $500, right? So you went from 1,000 to 3,000 down to $500. Now you're like, hey man, I just want to break even. That's the awful mindset, right? That's chasing your losses and basically being in that gambler mentality. Very, very wrong way of trading this strategy. Just take the loss if you have a loss, learn from the lessons, move on. The psychology trap is pretty real when you have a lot of profits, and then some of those profits end up, getting away from you, and you lost some of those profits, and now the market has humbled you, but you are angry. Okay, anger is not a good place to put in the market. Okay, maybe you go to the gym or the punching bag or whatever, but it's not a good place to put your anger in the market, because if you will chase and revenge trade, you will absolutely lose even more money. All right, let's talk about portfolio allocation and diversification. Proper portfolio construction is the difference between consistent returns and bust cycles. The core principle is never have more than 20% of your buying power in any single position. With a $50,000 portfolio, that means $10,000 in each position. This might seem limiting, but concentration risk can be a real killer. I already mentioned how some people, they sell a put option on Tesla, and that's their entire portfolio. It's like 90% of their portfolio, and when it goes underwater, you got some really big issues now. This gives you proper diversification, liquidity for other opportunities, by the way. So if you have several positions, one position, is doing okay, but you see a really good opportunity, it allows you to actually sell that position that you don't really like as much for the new opportunity that has just come up. So for a $100,000 account, $20,000 is pretty much the highest you should ever go in any one position. And then having cash, again, as we discussed earlier in this course, is also a good idea. It can be between $10,000 to $20,000 of your portfolio. 20% can be in financial stocks such as banking, insurance, payment processors. 20% can be in consumer stocks, whether it's retail, maybe that's a Nike, restaurants, maybe that's Chipotle, or other big brands, right? 20% can be healthcare. Now, I don't recommend going into specific biotech healthcare stocks. A lot of people think, this company is going to go to the moon. You don't know when it's going to go to the moon. It can go down. You can go down a lot in the short term. It can go to the moon in 15 years. You don't know. There's no time. But that is the most out of control stocks for our period. So when you go for healthcare stocks, go for the bigger companies. Pharma, devices, and insurance is fine as well, right? Now, 20% industrials, materials, energy. I would put those kind of together. I'm not a huge fan of those. I personally have a lot of experience analyzing those types of stocks. I have a lot of experience analyzing technology companies. That's what I did on Wall Street. I was a tech analyst for a year. But if you understand tech deeply, you can go even higher. For me, my portfolio is weighted very heavily into tech companies just because I understand technology. I'm bullish on tech. I'm bullish on AI. I was early on Palantir, on SoFi, on NVIDIA, on many other tech names. And I just understand them very well. I understand valuation very well. And that's where I have most of my experience working on Wall Street. Not only at one job, I've had multiple jobs. They were all around tech. Because once you have an expertise, you get hired from other banks and firms and hedge funds within your area of expertise. So I kind of started in tech, and I actually started in esports, and I was looking at stocks like Take-Two Interactive, Arts, those type of gaming businesses. And then I expanded more into NVIDIA, and I was actually looking at NVIDIA back in 2016, a very long time ago when it was a dollar stock. It was in the low dollars, like $5, $8, something like that. So, I invested some money, but not enough to be meaningful at that time. I was very, very broke. But you want to really have a concentration in the area that you understand. If you're following me, you're watching my videos, and if you subscribe, you are probably going to be more heavy on the tech stocks, and that's really okay. Now, do pay attention. Correlation matters. It matters a lot. If 5 stocks that you have, your entire portfolio, only in tech, that could be an issue, right? So, although tech heavy is okay, in my opinion, I allow that because I'm an expert in that area. I still want to have other sectors, right? Now, we talked about time diversification, so I just want to really bring this home. Time diversification through expiration dates prevents cluster risk. Don't have 5 portfolios expiring on the same Friday. Spread them out. In one, you have 2 expirations, and then in 2 weeks you have another 2 expirations. Maybe it's in 5 weeks you have 2 more expirations, right? Now, But we also say geographic diversification is also overlooked. Although a lot of big U.S. companies, they already have a lot of diversification because a lot of them are multinational companies. If you think of, Coca-Cola, they have Coca-Cola all over the world, whether you're buying Dubai at the moment, or you're in Eastern Europe, where I travel a lot, Middle East, or Asia, or Africa, whatever. There's Coca-Cola everywhere, right? But also, there's even Nike's everywhere, right? A lot of these companies, they're everywhere, right? But SoFi is not going to be so much an international company. And it is, right? American Airlines, well, the name says American Airlines, and they have most of their routes within America. I think maybe they go to Mexico and stuff like that. Now, keep in mind the barbell strategy works really well for puts as well. So sell mostly conservative, far out of the money puts on quality companies, but also take into account the temperature band. So if you want steady income, the allocation can be 10%, but also few other factors, right, that I already discussed in the technical analysis portion, right? We got the aggressive market chains, we have Bollinger Band, we have RSI, we have moving averages. All of these factors you want to basically create into a scorecard, and the higher your scorecard scores on these 7 factors, the better it's going to be. And one more thing, again, to have on your scorecard is the VIX, right? How high is the VIX? When the VIX is higher, it's actually a great time to sell put options. With that being said,
Erasing our
deeper into the VIX. So the VIX is called a fear gauge for a good reason. When they're panicked, well, that's actually a good time because the VIX is going to be higher, and you are the one that is taking advantage of others as they basically running away, they're selling their stocks at a cheap price, or simply when people are willing to pay more for options. Okay, when VIX is higher, options are more expensive. They're more expensive because there's more uncertainty. Uncertainty means risk, and risk and return are 2 correlated things, right? So of course, if you're making a super safe bet in a real estate example, you go to a good neighborhood and you make an investment property and you rent it out, and the house is $1 million, and you rent it out to some CEO or a family that has a take-home income of $400,000 per year. That's obviously pretty safe. That person's probably not going to default, right? If they have a 2-person household income, one person's a doctor making $250,000, his wife is $150K, whatever, nurse practitioner, then pretty much going to get paid on that property, right? So you're going to have lower returns because you're not going to be paying a super high rent. You have to be more competitive, right? And if you go into like a trash neighborhood, not really, or like North Philadelphia, and then you have like these rundown places with not the demographics of people with jobs. Let's say there's a lot of crime, and the average income is like $20,000, really low, right? I don't know what it is in Philadelphia, but if it's really low, there's a lot of crime, there's a lot of defaults in that neighborhood, right? Of course, you want to get paid a lot more for your rent, right? It would only make sense that you don't have an A++ tenant. You have a tenant that maybe is in and out of jobs, has low income, has low job security. So you get an investment property there, you're going to want more money, right? Same thing with the VIX, man. It's the same exact thing. It's just risk. VIX is risk. Uncertainty. If there's more uncertainty, you want a higher return, right? I'm just trying to help you understand that the higher the VIX is, the more risk that investors are expecting. The higher there is risk in the market expected, the higher the premium has to be on options, right? Because there's a lot of profits to be made. It means that volatility realizes, right? The volatility of the VIX is basically a 30-day outlook on how much investors expect there to be volatility, right? 30 days ahead. It's actually one of the best metrics that I personally love. It's one of the only forward-looking metrics, right? A lot of people watch the news and they read about, things that have already happened that announce these rates, and then everyone is like, oh, well, because this happened now, this is what I'm going to do in the market. No, that's already in the past, man. We're already behind. 2 things I know is building permits for real estate is like, that's a forward-looking number because that's future potential buildings that are going to be built in VIX. VIX is like an expectation from the market in terms of volatility for the next 30 days. So when VIX is higher than 30, amazing. That is a time where you should be deploying a lot of your cash to sell puts because your put pricing is going to be higher. That is what you want versus very low volatility. Yeah, we're in a pretty bullish market with no volatility. Well, selling the put option you're not going to be able to hit 1% a week. That's one of my goals in my program is I want to get 1% a week in premium collected at least. So let me show you the real numbers right now of how the VIX looks and then how it impacts put selling prices. So VIX is super interesting because the higher the VIX is, that's basically the fear gauge on Wall Street, and higher VIX means that option premiums are going to be elevated. When option premiums are elevated, it's a better time to sell. Right now, VIX is sitting at 16, but if you're watching this in the future at some point, anything that is basically above 20 is essentially elevated levels where option selling is good. Anything below 20 is you can still sell options and you still want to sell puts. on a long-term basis, but it's not going to be really as profitable here. We can see that in November, VIX spiked up to 26, then in October it was also 25. But usually VIX has been pretty low because we've just been in a really good bull market. Now, of course, April was when VIX went absolutely wild to 50. And if you sold puts here, you would have literally collected like gold bars. It's super heavy gold bars that you cannot even lift. Right now, if I go back 5 years, we all know, actually 5 years ago, wow, COVID times were also elevated, right? So you want to actually look at VIX when it's higher as a opportunity to sell more put options because it's going to directly impact your implied volatility. Now keep in mind, there is something called mean reversion. Mean reversion happens. Technical analysis, mean reversion also happens with volatility. So when the VIX is high, it is going to come down. There's an average VIX of like 17 or so, right? So if you're higher than 17, it's a little bit better of a time, right? If it's higher than 25, that's a good time. If it's higher than 35, and like you should be deploying your capital like no tomorrow. You should be going to your bank, Mr. Bank, I need that money. I need to deploy that capital into the market. And of course, the bank's going to say, we lend your money out. We don't even have the cash. Anyways, you see what I'm saying? You want to deploy that cash, right? And here's one of the traps. Volatility clusters.
Lend your money out. We don't have the cash.
So if the VIX spikes in the short term, like it did back in March 2020, the VIX stays around 30 for 2 months. That did happen, right? We had some more tougher times, right? We had a pandemic. Then put sellers can actually be very, very take an opportunity, but it's also a time of higher risk. So of course, if you have a pandemic, then you might want to take a little bit easy. However, I'll tell you that I turned my portfolio from $100,000 to $700,000 in that pandemic. That was when it was super profitable for the trade, and I've used several strategies that I talk about on this channel pretty quickly. Like it was very, very quick. So opportunities is actually the time to make literally millions of dollars. Like people have made millions of dollars at times of crises, right? So just because there's a pandemic and there's issues with businesses closing, that's just one pocket of the economy. There's other pockets of the economy that are absolutely killing it. The mental league of put selling is what separates long-term winners from really long-term big winners. You can know all the technicals, you know everything else that I talked about, but if you end up getting assigned in a position, changing your mind, getting out of that position, one mistake can literally wipe out $5,000, $10,000 or more in profits. And every single year over a decade, you can end up making $100,000 less than you would have if you had known these psychological tactics that I'm about to discuss right now. I study a lot of psychology because the market is a tremendous amount of psychology. So it's really important, no matter how boring you think psychology is, it is extremely important to your profitability. All right, our first lesson is going to be overconfidence bias, which is really interesting, and I'll explain to you what this looks like. So first of all, I'll give you a shocking example of overconfidence bias, and that's that when they have surveyed drivers, okay, 80% of drivers believe they're better than the average driver. It doesn't really make sense. 80% of drivers believe they're above average, but by definition, average means that it's 50%. So that means you'd be better than half, and then you'd be worse than half. But 80% of drivers said they're better. So that explains to you that overconfidence is most people think that they're much better than they actually are. And I don't mean to hit any egos here, but we all have an ego, but you're probably not as good as you think you are because we all have blind spots and we all have room to improve, right? That's what I always think. I've been doing this for a decade now, and I have one portfolio that I've grown to 3.5 million. I have a second portfolio that's also around that same value that I've both grown over a long period of time. And I'm still, luckily, I don't know why this is, but I've just been really humbled. I did a lot of martial arts or maybe whatever. I don't get overconfident in my portfolio. I am just as good as my last trade. That's what I always tell myself. Okay. Same thing with Amazon CEO, right? Jeff Bezos basically said he expects Amazon to one day go bankrupt. He expects there to be competitors. He expects that Amazon may come into issues down the road, and they must function as day one of the company. Okay, guys, I want you to have the same mindset, right? Because this course, my chapters will teach you things that will help you trade, and it's most important for you to have a good mindset. That's like basically having good hygiene or good health, right? It doesn't matter if you're the smartest person in the world. If you don't take care of your health, it's useless, all right? Same thing with psychology. If you don't take care of your psychology, you are going to get yourself in a big hit when it comes to investing. Because I've seen students that are like, I made $11,000 the past 2 months on my $150,000 portfolio. Fantastic. I asked him, how long you've been trading for? He said, 2 months. That's my first 2 months. I said, beautiful. That's amazing. How did you do that? He's like, I'm just watching your videos. Fantastic. But I obviously it's been 2 months. The guy is having good performance, but he definitely has a lot of blind spots, right? He definitely has overconfidence bias. He said we should coach together. He said, no, I'm going to keep doing it myself. No problem. We're going to see what happens there, but I just want to say that the more you know and the more you're aware of potential mistakes that you can make and not getting overly cocky, the better, right? I'm not saying something bad's going to happen. I don't know, right? But I do see that overconfidence bias affects people very negatively. They have many good months, and then boom, they have one bad month, and it's not that hard to blow up an account. Also, it doesn't look as bad, but it's actually bad. I see people that have a 45% return in 6 months. They're very pumped. They're like, oh, I'm going to do fantastic. They have 1 month that's losing, which is negative 8%, which isn't even that big of a loss, right? Negative 8%. The next month they have negative 2%, right? And then the next month is, let's say, 0%, and then they start getting revenge trading. Okay? I have a student that I actually will put on this channel that I talk to in my real course, which is coming out very soon. Make sure you subscribe for that. I have the best courses coming out for free on YouTube. It's freaking insane. I'm just putting everything I have here because I'm super motivated to help you guys learn. I love what I do, and I just want to be the #1 coach here and give you better free information than people charge for. So look, what I was trying to get at there is that if you have a 45% return, and that's negative 8, then it's negative 6, and then it's negative 2, your overall 1-year return can actually be 20%. That's crazy. You can start off with a 45% return in the first half, and because your second half is bad, you end up with a 20% return. It is not a sprint, guys. It is not a sprint. This game of investing is a long-term game. That's why I don't get emotional when it comes to investing. It's because I've been doing it for 10 years. I see the market fall. I'm like, oh well. I see the market going up. I'm like, oh well. All right. There's a story of, if you have the attention span for this, by the way, congratulations, because you're going to be a better trader. People that don't have an attention span, they're bad at trading. So congratulations for being in this part of the video. So once upon a time, there was a Chinese farmer who was forced to run away. And that evening, all his neighbors came around to basically say, we're so sorry to hear that your horse ran away. This is the most unfortunate. The farmer said, maybe. The next day, the horse came back bringing 7 wild horses with it, right? And in the evening, everybody was like, the horse came back and it brought 7 other horses, man. Congratulations, now you have 8 horses. The farmer said, again, maybe. The following day, his son tried to break one of the horses, and while riding it, he was thrown and broke his leg. Okay? And the neighbors were like, oh, that's such bad news. That's so unfortunate. And the neighbor said, maybe. The next day, the officers came around to script people for the army to go to war. All right, and his son had a broken leg. So again, all the neighbors were around saying, "Wow, you got so lucky! Holy moly, your son doesn't get to go to the army to fight and potentially die, right?" And you guys can guess, the story's almost over. The guy says, "Maybe." Right? It's really impossible to tell whether anything that happens in it is good or bad, because you never know what will be the next consequence or the misfortune. All right. You never know what will be the consequences of good fortune either. That story kind of paints you the picture that it's maybe. Every trade is a maybe. Don't ever get hard on yourself. If a trade doesn't go your way, it's okay. Make sure that you're playing the long game. It is the long game, right? The guy broke his leg. They said, oh, that's such bad news. Well, he said, well, maybe. The next day, they came to draft the army, and it was good news, right? So bad news can be good news can be bad. Similarly, in trading, most people think that they can consistently outperform the market. But studies show that over 90%, so I said over 80% of drivers think they're good. Traders are even more cocky than the drivers, okay? So 90% of traders, of active traders, underperform the S&P 500, yet 90% of people think that they can beat the market. Guys, 90%? Are you kidding me? 90% of active traders can't win. It's good, but I teach option selling and collecting income with the wheel strategy mainly on this channel. Overconfidence can be extremely dangerous, especially if you're making money and you start buying options. Okay, I've seen that happen. I've also seen people just increase their deltas and chase higher and higher premium. Then all of a sudden you see them selling at the money puts on GameStop, or at the money puts on Rivian, or at the money puts on high, really, really risky stock. So make sure that you're aware, guys. If you're aware, right, and I'm a man of faith. For me, it's important to understand who I am, what I'm doing for other people. It's important for me to have a good connection with God. That is very important for me. And whether you're religious or not, I want you to understand that being more in tune with yourself and understanding yourself actually makes you better in all areas of your life. It makes you better at relationships. It makes you better with other human beings. It makes you a better personal role, but it also increases your results, okay? I'm a firm believer, right? I wasn't always the most religious guy, but as time goes on, I'm building a relationship with God. I'm building a relationship because I've achieved everything I could possibly hope for. Now I'm giving it back to you, and I'm thinking, how did I do this? Well, maybe some of it is luck, maybe some of it is hard work, but I really think that I've actually been doing the right thing in life, which is why I've gotten success. So I want you to have that same mindset, which is, always be humble. Be humble. It doesn't matter how much money you have. I have a ton of money. I have more money than I show on this channel. I have enough money to do a lot of things with, right? But I'm not getting overly cocky. I'm still showing up here on this YouTube channel, even though I don't need money. I'm still showing up. Yes, I have a business. I'm a coach. I have a big team that I want them to do really good. They have families to feed, so I do charge for my coaching, and I have an exclusive luxury coaching. I work one-on-one with folks, but it doesn't stop me from understanding who I am, being humble, and not getting overconfident. And also, a study published in the Journal of Finance found that overconfident traders are 60% more likely to trade options excessively, believing that they can predict short-term market momentum or movement. Even in good times, you have to prepare for the tougher times that can potentially come. Even when earnings are good in a stock, right? You see it all the time. You see earnings that are good, the stock can still go down. So it is always humbling, actually, when I predict the stock to have good earnings and it has good earnings and it still goes down. I say, it's a good thing you had proper risk management. It's good that you had proper asset allocation. I remind myself that I'm humble going into the trade because I have diversification. I knew the stock would beat earnings, but the market didn't agree with me. The market can still go down. So I can be a genius and predict everything, but I can still be wrong because this is a very humbling. Also, I just want to say that when you're excessively trading, even if you're right, excessively trading in general is also bad behavior because this behavior often leads to higher transaction costs and on average, lower returns compared to more cautious traders who limit their volume of trades. That's why in my community, I'm just following literally 15 to 20 stocks and I just run the wheels, sell puts, cover calls. I do some spreads as well. For sure, it's easier for me to focus on folks that have $50,000, $100,000 portfolios or more. It's just easier to scale. So I do prefer working with folks that have at least $25,000 to trade would be kind of like fair. If you want more help with selling puts, you want to see all the trades that I'm making live, and I do that all the time. I do that every Monday and Wednesday. I'm taking positions. I'm doing the research for you. I'm saving you a lot of time. I've been doing this for 6 years now, and I've taught over 2,000 students. And I have a lot of content and information that I cannot share on YouTube. Some of it is just a little bit maybe more aggressive, such as margin selling. And some of it I just save for the community because I want to help people further, and I actually love working with people on a one-on-one basis. So if you want more coaching, you want to learn more about my program, click the first link in the description. Also, one last thing, okay? With selling puts, now that you have mastered it, rewatch this content, really learn it, get the solid knowledge through this. Selling puts is just a gateway. It's a door into your real strategy. And I also have a free course for you to watch further, and that course is for sure going to level you up and take you to the next level with option trading. So check out that course right here on the screen right now. Volatility is picking up in early 2026, and so far, the first quarter, it's pretty shaky. A lot of investors are worried about the AI bubble because search results for AI bubble is very high right now, as well as some swings in the stock market due to some tariff concerns. And what I see going on right now is retail investors are either panic selling on red days or they're frozen. They're frozen in cash. Well, I have a solution for you. Uncle Henry today is going to discuss selling put options, and I'm going to tell you how I view put options and how to sell them, how to pick the strike price, the expiration dates, and much more in this video. Before I jump in, I just want you to know that I am not a financial advisor, nor am I licensed or registered, so you should always be safe with your own money, consult a professional, and don't risk more than you can lose. I personally like selling put options, and I personally have been doing so for about a decade now. Since I studied finance and started working at Goldman Sachs, I've been playing around with options, and for me, selling put options has been a great way that I have personally grown my own portfolio. So my goal is to educate you and reveal everything that I can in this video. So this is going to be the most valuable video that you can watch on selling put options. So make sure to get a notebook out and a pen, and let's get into it. When there's more fear in the market, there is elevated volatility. When volatility is higher, option premiums are also higher. When you're selling a put option, higher volatility is a good thing, especially because higher volatility typically happens when the market pulls back. So in reality, when the market is down and other people are being fearful, it's actually a great time for you to actually be greedy and take advantage of other people's fear. And one great way of doing that is by selling put options. I'm going to show you some awesome examples in this video. When you sell a put option that's out of the money, you save because you don't have to buy the current stock at the current price. So when you sell a put option, get yourself kind of a margin or a discount on the stock if you do get assigned, and overall you get to collect premium
risk that you are taking. In my opinion, that's a smart risk. I'm going to categorize it as smart risk because you get paid and then your risk is assignment. And one of the biggest things with assignment is if you have a high quality company and you do get assigned, as long as you like that company, you're not really in a bad situation. So I'm going to put on the screen right now and we're going to go over what a put option actually is, how to execute one, and then we're going to go over some real examples. So a put option is a contract giving someone the right to sell a stock at a fixed price. When you sell a put option, you're agreeing to potentially buy the stock at your chosen level. That level is called the strike price. If the stock stays above your strike price, you keep the premium. If it drops below the strike price, you have to buy the shares at the effective strike price which you sold the put option for. The cash that you collect in your scenario is going to be yours. You sell the put option, the cash taken in your account. However, your account balance doesn't go up because you have a account that is currently active until expiration. You have the obligation to purchase shares should those shares go below the strike price. And yes, there's also something called So, in one scenario where you buy the dip, buy stocks at the current level that they're trading at. However, when you sell a put option, you're agreeing to buy the stock at the price that you choose. So instead of guessing the bottom, you set a price in advance. The price that you set can be really any price. Of course, as we will see, the lower you go, the further down you go, which means you're more out of the money, the lower premium that you can collect. Because it's all about risk and return. The higher the risk of assignment, the more premium you will collect. And the lower the risk of assignment, the lower premium you will collect. So it really is about balancing this equation and finding your own sweet spot. I personally have a sweet spot, and because I respect your time, I'm going to give you the answer right now. My sweet spot is 30 delta. I am usually selling a put option at 30 delta because I have found, for me over the last 10 years, that has been a great sweet spot for me. Because if you sell a 30 delta, that means there's a 30% chance of getting a sign, and a 70% chance that you do not get a sign. So, in my experience, it has been a great mix of premium that I have collected, and the chances of getting a sign have only been about 30%. I have really enjoyed stocks to drop, and for me to purchase those stocks that have dropped to a level that I feel comfortable at. It forces discipline instead of emotional entries. So when the stock market is falling, oftentimes investors, we may say to ourselves, hey, we like this stock, but we're scared. Right now, it looks like a falling knife, but we're all confused. Well, instead, a more strategic approach to it would be to sell a put option a few dollars lower than the current stock is trading at. For example, let's say that we have NVIDIA stock at $108 per share, and comes down a little bit, now it's trading at below 170. Let's say it's $171 per share. Well, instead of buying the stock at $171 per share, if you instead would like to buy for $165 per share, you can sell a put option at the 165 strike, and then if NVIDIA goes down to 165, when it's at expiration essentially, then you'll get a sign. And that, in my opinion, is much better versus just buying the stock at $171. Because 171, maybe that is the lowest price that NVIDIA would be at. But when I sell a put option for 165, I am more comfortable because I have a $6 cushion. There's $6 difference that if the stock goes down by $6, well, the stock holder ends up losing that money directly versus someone who sold a put option. You still will get a sign under 165, but the loss from 171 to 165. That $6 difference is pretty much the stock going down and how much the stockholder lost when he bought at 171, but you don't actually do that until it hits 165. Because you also collect some premium, even if NVIDIA were to go down below 165, well, even if it's like 30 cents or 50 cents down, let's say that it's at 164.5, if you collected $2 premium, well, then your effective average loss is actually 163. So even if NVIDIA goes into the money and you do get a sign and that risk ends up realizing, you can still be up depending on how much premium that you collect. Again, I really want to caution you because option trading is risky. If you lose all your money, you're buying options. And you really need to understand that when it comes to selling a put option specifically, you need to be very disciplined with your emotions as well as really like the stock that you're selling a put option on. Because if you sell a put option on a stock that you don't want, then yes, assignment really sucks because you don't want that stock. So the biggest mistake is chasing high premiums. But if it's a stock that you really like and that you want to get a sign on, and I'll show you, let's just go over an example right now. So I want to show you my portfolio here.
example of a self-put position that I have right now that's in the money. So I have a lot of covered calls right now. Okay, I do have a self-put right here. So I do have one self-put on Palantir, which is a lot higher, and Palantir is a lot lower. I personally think Palantir is going for an absolute steal of a price. I believe that the company has great long-term potential, but of course, the stock is down a lot. So I have a very deep in the money put option, which has very high risk because it has very high delta, and I will be getting assigned pretty much 91% delta here. 0.91 means there's a 91% chance that I'm going to be assigned on this position. So is this a bad thing? Well, the position sizing is really small, so it's only one contract. So keep in mind, whenever I make mistakes, I try to keep the mistakes as small as possible. And whenever I have wins, of course, I try to win big. So that's kind of what I'm trying to do, where I'm trying to balance. And in this scenario, this example, Palantir is going to be assigned to me, and I don't actually mind being assigned because it's a stock that I want to buy. So this is kind of like an older position, but I want to show you a newer position that if I were to open up today, where would I not really mind? So let's go to Robinhood. So Robinhood is down a lot. The stock just really doesn't make a lot of sense because they're making money. They're making money bicep over tricep, but the stock makes no sense. Like the stock is just down heavily, and a lot of that has to do with crypto. And over the last 3 months, the stock is down 35%. So what would I do if I wanted to basically get into a company like Robinhood? Rather than buy for $78.91, there's two things that I can do. And the first thing that I can do is I'm just gonna go for, let's go for like a medium term option. Let's go for April 17th. This video is a guide, so you might be watching this in
chest and you go right like that horrible feeling. So that was you. I said, stash. Latinos, that paradise smelling, the original OG. Get that paradise smelling, take my vitamins. Oh, that's okay. And we stop drinking it. Then we drink it all. And then after I take my vitamins, I make sure you eat some food because it's important. The food helps kind of put those vitamins down. This right here, what did I say, Ricky? 40 inches, right? 43.
Well, there's where you're coming in. You're coming in over here.
I measured basically. I measured 37.
I wish that meter fan was down, but it couldn't be.
No, because we were 1 inch. We were 1 inch out over.
No, I know, but we should extend it. Only reason being, because once I mount that panel, you see what the knockout is? That fucking, the main's gonna show.
We basically just want to go 3 foot off the ground. And then put the box holes. I already measured the holes and everything in the box. And that's got studs to measure. So the bottom of the box will be here, right? The box will basically to the bottom right here. This screw. We have to change this thing, right? Because this, when I say they call it this, we have to have the main use.
So the metal we measured needs to be there. There's your meter. Is your meter?
That's the, so 9.5 inches.
Yeah, I'm pretty sure.
This is the meter, guys. But this screw has got to be 9.5 more inches over, right? With the 16-inch bar that we're going to put in. So we got to make sure that we're far enough over here. Does that make sense?
So all you're doing is that one person was short. You just checked it out. That's the only one. So that's what I'm doing.
Yeah.
I don't care about it.
But I measured. So it's got to be here.
You understand? That nipple that's coming out of the meter,
Yep.
that goes to your panel. Wherever that is, that's where your panel's going to be. So when I measured it, or I eyeballed it, we're pretty much over
So
here.
you're saying that nipple that comes out of the side of the meter has to go,
underneath our
but it's got to go directly into it. It can't go down and up and in.
Oh, no. It's a nipple. That piece of nipple.
Ooh, yeah, so that fucker needs to be high as shit.
Don't worry about it. I think it's 42 inches.
37 and a quarter.
Also 30. Alright, so we'll say 30.
So 38 is there. It's right there. Yeah, that's like that's a stretch. I'm not gonna stretch like that. I was gonna say 6'6".
Yeah, no, I think you're good. You'll be fine. I think you're good. Let's do this. Hold on.
No, that's not 6'6".
Yeah, but let me take this off real quick. Let me do this. I'll let you know what I look at. Because I gotta take this off. So I'll probably I'm so proud of you that you left me. I left your son alone. I'm so proud of you, man.
Sometimes you gotta let your boy off one of them.
Thank you, Dad. But this is yours. And if we need, I gotta get a wire. I have it at home. But you need a Cody. You're doing fucking sweet, baby. I think that's a big deal. You want to go Home Depot and then we'll come back?
Yeah, you're right, my
It's not
truck.
gonna rain, is it?
I'm gonna ride my truck.
We won't shit.
Yeah, my truck. Yeah, what's the other side? Yeah, what's the tree? Alright, guys. Steps in Tuesday. We gotta get in the zone for this workout, right? Leg day, baby. Even though we have like 50 leg day videos on YouTube, I'm doing this one for everybody that says stacks don't hit legs. I mean, I always hit legs. I just don't like to film it because it's vicious. It's deadly. Leg day for me sucks. Lots of reps, high volume, just mind to muscle connection, time with attention, just supersets, drop sets, lunges, with leg curls. You got a lot of good equipment here. That's what we can do. Shit, gotta go.
You know what? Even though you got 50 leg day, this is the first leg day here.
No, I've done legs already.
Well, 50 yards, yeah. My first leg day.
Show this out. Show some abs so my pre kicks in. Warm up some legs. Then we do some, yeah, it's pretty cool catfish. I don't know how my toes do it. Ooh, my knees hurt. My right knee. Let's go back here. Arms. We got to. Take what you gotta get the legs.
Oh shit.
Supersets in between. Just keep the blood in that muscle. That way, it don't matter how much weight you're using. The blood's in that muscle. It feels like it's a million bullets. Take 5. Real breather.
Fuck. Fuck. Fuck.